Hello everyone, this is Brooke, DeFi analyst from TID Research, and today I would like to talk about a very interesting protocol called YieldBasis. So YieldBasis is a new DeFi protocol where it helps users to build leverage LP positions on Curve for BTC and the crvUSD pair. However, with no exposure to the impermanent loss risk, yet the user are still able to earn the amplified return from the LP fee, from the volume, and also from the, for example, CRV reward from the gauge weighting emission. And so in this video, I'd like to first talk about how this works, what's the mechanism of YieldBasis, and later we'll like to talk about how the yield is generated and where the APY you're seeing here is coming from. So first, let's look at how YieldBasis works. So the core issue, the problem that the YieldBasis is trying to solve is that for a DeFi ecosystem to grow, there must be enough liquidity. However, the biggest blocker for people to supply liquidity is that there's always going to be impermanent loss. Even though different kind of DEX, for example, Curve, Uniswap, they're all trying their best to incentivize the user to supply liquidity with their own governance token. However, for the volatile pairs, such as BTC to crvUSD pair, the impermanence is sometimes just too large, and then therefore discourage people from supplying enough liquidity. And therefore, with no liquidity and other DeFi users, for example, people who want to build leverage positions, are not really able to do so because whenever they swap, there's going to be a huge price impact because the liquidity is not deep enough. It is actually pretty fair to say that the swap liquidity is one of the most important part of the foundation for a healthy DeFi ecosystem. And that's the reason why YieldBasis is very important. So for a little bit of context, YieldBasis is also built by the founder of crvUSD, which is one of the largest DeFi protocol right now. And later on, when we talk about the mechanism, we'll also see how the success of YieldBasis will help to boost the TVO on Curve and also make the liquidity deeper volatile pairs on Curve. So in the doc, you can see that the problem that it's trying to solve is the impermanent loss. A little bit of intro. The impermanent loss is the loss you might be exposed to. You supply liquidity to a volatile pairs, for example, BTC, crvUSD. And then this is a little bit of a numerical example. So say you start when the price of BTC is like 100K, and then you supply into where BTC and crvUSD, where the ratio is like 50-50. So you supply one BTC plus 100. And at the very beginning, the USD value of your LP position is 200K. And let's say that the BTC price goes up by 50%. And then if you stay in this pool, at the end of the day, your LP value in the USD terms is only going to be around 244K. However, if you just hold one BTC and 100K of the crvUSD, when the BTC price goes up by 50%, the value of your position going to be 250K. So the gap in between is where we call the impermanent loss. And for YieldBasis situation, they introduce a new mechanism where it allows you to hedge away the impermanent loss, even though you are still supplying the liquidity. And the mechanism is that the YieldBasis help the users to always 2 times leverage. When you deposit into the YieldBasis, you can only deposit through BTC. And when you deposit the BTC, YieldBasis will help you to go to Llama Land and then borrow crvUSD. And so, for example, if you supply $100K worth of, they'll borrow $100K worth of crvUSD. And then they will supply both the crvUSD into the online liquidity pool. And then they will use the liquidity pool as a collateral. So it means that for the whole position, it's going to be worth 200K. And then your margin going to be 100K. And then it means that you're going to farm with the 2 times leverage in the LP positions. However, if it's only a LP position, you're still exposed to the impermanent loss. And that is how they are going to help you to hedge away the impermanent loss. And the key is that they always keep your positions at 2 times leverage. So figure out where the impermanent loss is coming from. Impermanent loss is coming from, it's there basically because when market is going up, you're selling your BTC. If the market is going down, you're buying more BTC. So when you would have made more money, just hold a BTC as a liquidity provider in your liquidity pool, you are actually selling BTC. So when the market goes up, you're earning less. And then when the market is going down, you should have to sell your BTC as soon as possible to stop loss. However, as a liquidity provider, because you cannot initiate any transaction proactively, you can only let other people to trade against you. And then other people, rational traders, when the market is going down, they're selling their BTC to stop. So when the market is going down as a liquidity provider, you are buying more BTC. So you can see when the market is going down, you are losing more compared to just holding one BTC and the stable coin. So that is the curse of being a liquidity provider, is that you are always being traded against. So when market is going up, you're selling. When the market is going down, you're buying. In the BTC and the crvUSD scenario, you're selling BTC when the market is going up. You're buying BTC when the market is going down. And so that is where the impermanent loss is coming from. And if the YieldBasis can help you to keep your position at 2 times leverage, the impermanent loss can be. And this is why. So let's say BTC price goes up. So keep in mind that you're currently in a liquidity pool and the BTC price goes up, even though you're going to suffer some impermanent loss, but the USD value of your position is actually increasing. So it means that the leverage of your position before any adjustment is actually lower than 2. So YieldBasis will step in and then borrow more crvUSD with your LP as a collateral to bring your leverage back to 2. And with the additionally borrowed crvUSD, they're going to swap those for BTC and then supply into the liquidity pool. In this case, the BTC purchase with the newly borrowed crvUSD will hedge against the BTC you're selling when other people come into a liquidity pool to trade against you. Therefore, by keeping your leverage at 2, YieldBasis basically help you to hedge away any BTC ratio shift in the pool. So it means that your leverage will always be 2, and the impact of that is that when the market is going up, you'll borrow more to buy BTC, and therefore your holding as a liquidity provider will be the same. Even though when the market is going up, people are still coming to the pool to trade to buy BTC from you. And when the market is going down, your LP pool value is also decreasing. So it means that you'll need to repay some of the crvUSD. So YieldBasis will help you to withdraw some BTC from that liquidity pool and then sell it into the crvUSD and then pay off some of the debt for you. So it means that as a liquidity provider, when the market is going down, you're buying BTC. However, if you do your LP through when the market is going down, YieldBasis will also help you to swap your BTC, withdraw your BTC, and then swap for crvUSD. So the selling made by YieldBasis will offset the buying people initiated against you because you're an LP. And that is the reason why the LP position on the YieldBasis can have no impermanent loss. And then keep in mind that even though for the numerical example, the BTC move here is very huge, YieldBasis do all this adjustment automatically. So it means that whenever the price move, even though only by a little, the YieldBasis will calculate according to the current gas price, according to the current pool size, according to the current possible price slippage. Does it make sense to make the adjustment? If it makes sense, they will just make the adjustment almost continuously. So it means that your leverage rate will always stick with 2%, even though the BTC price might have only moved, for example, 0.5%. So it means that your LP position will always perform very similar to just holding the 1 BTC in 100K. And what's even better is that even though the value perform like holding 1 BTC in 100K, because you're essentially providing liquidity into this curve pool, you are still earning this LP APY. And what's even better is that because you are funding with 2 times leverage. For example, you can see the crvUSD, CBBTC here. The daily APY is only 17%. However, if you go to the YieldBasis website, you can see it's actually 29% because you're with 2 times leverage. And that is why YieldBasis is so interesting in the sense that it's trying to solve the most difficult in the DeFi industry, which is that the volatile pair, no one wants to supply liquidity for volatile pairs, even though all the DEX trying to provide incentive for people to do. Just that the risk of impermanent loss is too huge. And then still, despite the incentive, no one wants to do it. And then YieldBasis is trying to solve this through an organic way. And you can see, for this, they're actually not getting any incentive. However, for YieldBasis, the TVO is still pretty huge, and then they are already at the capacity. And that is how YieldBasis works and where the yield is coming from. And then one additional note is that ever since the YieldBasis is launched, a lot of people are saying that the launch of the YieldBasis will weaken the peg of crvUSD. However, that is actually against the intuition, because when crvUSD peg is usually under pressure when the market is going down, because crvUSD is a CDP. So it means that it's backed by all these volatile assets. People can just put this volatile asset as a collateral and then mint crvUSD. So it means that when the market price is going down, the ratio drop, and then for the crvUSD peg will be under more pressure. However, for the YieldBasis situation, when the market price drops, say for example BTC down by 50%, that is when the YieldBasis will help you to withdraw some BTC and then use it to buy some crvUSD. So it means that when the market price is going down, YieldBasis is buying crvUSD. So it helps to support the crvUSD peg, as a matter of fact. And when the market price is going up, it means that the collateral ratio is rising, and then the crvUSD peg under last pressure. That is when the YieldBasis will come to sell crvUSD for BTC. That is also a little bit of a side note about how YieldBasis can affect the peg of crvUSD.